Good afternoon, everyone. Happy holidays. And thanks so much for taking time out of our busy holiday schedule to join us. We obviously have a lot of new information that we finally have received in regards to the new COVID relief information that just recently came out. We realized that it's still in front of the president and not really signed, but we're just going to go on the assumption that the president will sign this into law. And so you can get a jump on what it means to you and your companies. Again, my name is Frank Milone. I'm one of the partners here at FML. With me today is Bill Claffey. He will introduce himself momentarily. FML, as most of you are aware, is a full service regional accounting firm. 85 people, 13 plus partners. Main office is in Glastonbury. We have offices in Enfield and throughout the state. And we've been all over this COVID relief and the PPP loans. And as many of you have probably followed us, we've tried to do our best on the webinars. And we will be doing that again today. We have a COVID task force, which is chaired by Bill Claffey and myself. And we continuously post information on our website, www.fmlcpas.com. We have a whole COVID-19 webpage dedicated to what we're releasing, and this will be soon on there as well. So as many of you know, we have a lot of information to go through. Bill has done an amazing job, as always, of getting through the information as quickly as possible, and he and I have spent a lot of time just to kind of make sure we have as much as possible, but just realize there's a lot of information in this new relief act that has come out, and we've done our best to try to summarize some of the main points that we think you all want to be a part of, just knowing as you're going through tax planning and year-end stuff. And then we will continue to delve into the details, and there are a lot of details to delve into, and we'll get more webinars scheduled, as soon as the new year turns. And then if you have any specific questions or specific information that you want us to cover in those new webinars, as you can always do, just reach out to Bill and I directly, or reach out to anyone you know at FML, and we'll do our best to include it in the next webinar. So without any further ado, I'll turn it over to Bill, have him introduce, and then we'll start the process here.
Great, thanks, Frank. Welcome back for folks that have joined us previously. Pretty exciting to kind of end 2020 with some of this news, which is going to be super beneficial to a lot of folks on this call and a lot of folks in general. It hasn't been a gift for me in the last 24 hours, but we did our best to get through it. And like Frank said, I think this will be to some degree maybe the 1,000-foot view. And as we have more time to absorb the act, which is 5,593 pages, and match that against the CARES Act and the Family First Coronavirus Act. I fully anticipate that we're going to be doing another one of these. Maybe there'll be some additional guidance that comes out in the interim. So we'll do our best to stay on top of that and delve into any details that we weren't able to capture today. But as Frank mentioned, I'm a partner with the firm. I'm on the tax side. Specifically working with a lot of state and local issues and a lot of credits and incentives. I have a JD. I'm an attorney by degree, so my insertion onto our COVID task force, I think, was natural as we were trying to plow through this, all the legislation that's come out. And it's really been an enjoyable experience, kind of going through it and doing the webinars with Frank and getting the feedback from all you folks on the other end of this. So I'm just going to dive in. As Frank mentioned, to the best of my knowledge, President Trump has not signed the legislation. I know he's had some comments on Twitter and some other social media platforms. I think most of those are designated towards some of the incentives and benefits that are foreign, not domestically based. So to the extent that he doesn't sign it and they go back to the drawing board, I think it'll be related to some more of the foreign benefits and not necessarily the ones we're going to talk about today. And also that this bill was passed overwhelmingly by the Senate and the House, and to the extent he doesn't sign it, I would expect that Congress would override the veto. So anyway, away we'll go. We'll assume that it's going to be law until we hear otherwise, and we're just going to walk through this. So this legislation is part of the Consolidated Appropriations Act, 2021 Consolidated Appropriations Act, which is just an annual appropriations act that gets passed. This one is obviously fairly robust at 5,600 pages, and it contains a lot of the COVID provisions, but it's all interwoven into. There's a lot of material out there. A lot of it is going to what we talk about today will apply to you folks. There may be other items in there that would also apply, but it's more targeted toward certain businesses. It may not have a kind of finance element to it. So in this act, they're designating $900 billion in the stimulus package, which is going to cover a lot of the things we're going to talk about today: the PPP program, the employer retention credit, other package extensions and tax extenders that are all, building into this $900 billion of funds that are in this package. We'll talk briefly about some of the unemployment provisions. In the past, we've worked with Updike, Kelly, and Spilacci to get some of their input on the unemployment. It's not our area and above my pay grade for sure, but as we start to get some more information on that, maybe we'll bring them in on the next webinar and they can kind of talk about some of those provisions in more detail and how that might apply to your business. And then the small business debt relief, which we'll get into. So let's just dive right in. Okay, tax provisions. Okay, so this is the issue. I think we've done a webinar on this. I know we've created some material for our website, but this has been, the one issue that I think has been at the forefront of most folks' minds that got the PPP loan. And I'm just going to give a little bit of background, just so you can kind of follow the logic here and understand kind of what happened and ultimately what this is going to mean to you. I mean, this is a nice benefit to you folks on the call. As of Friday, you were potentially, your business or you personally were down 40% on your loan, and now you've just picked up, that 30 to 40%. So if we go all the way back to the CARES Act, go back to March 27th, 2020, the CARES Act comes out, we go, we have the PPP, and there is a very specific provision in that CARES Act that says that any forgiven PPP loan would not be treated as taxable income. Now, typically the IRS would treat that as cancellation of debt income, and if any of you have had that in the past, right, that's taxable. So you may have a lender that that canceled your debt, previously. That becomes taxable. You got to pay tax on that, and that puts companies in a little bit tough spot there because they might not have the funds to pay that. Well, anyway, we go to the CARES Act. We know that there's going to be this forgiveness provision within the PPP, and Congress says it shouldn't be treated as taxable income. That's March. We fast forward to May, and the IRS comes out with this notice 2020-32, and basically they go through their logic of, well, if it's tax exempt income, then we're not going to allow any of the expenses related to that tax exempt income to be deductible. Well, that puts you in exactly the same position, as you can imagine, right? And so clearly against the legislative intent of the CARES Act, and actually and we've been having conversations with our client base, potentially put them in a worse spot because now they've got expenses that are not deductible. How are those going to impact potential credits? And so, like, I do a lot of work with the R&D credit, and we've been really trying to understand, well, what's going to happen here if this is not deductible. One thing that notice did not provide is anything regarded to timing. So it basically said if a loan was forgiven, that the expenses are not deductible. Well, you're going to take a 40%, 30 to 40%, depending on your tax rate, hit on that, and assuming that your states are complying with that. As a note there, Senate Finance Committee came out, basically said, we disagree with you. This is clearly against the legislative intent of the CARES Act. They also actually got themselves into a technical discussion of tax exempt income and how this didn't meet the requirement to be non-deductible, basically challenging the IRS on their own position. I'm not sure who wrote that up for Congress, but for the Senate and Finance Committee, but they did put a pretty nice 2 or 3 page letter together. Well, then we fast forward to November, and I believe we sent out a published piece on our website and potentially through email. IRS comes in with Revenue Ruling 2027, and they basically, not only do they double down on their position that, hey, this is not taxed, those expenses are not tax deductible, but guess what? You need to add them back into your 2020 return, even if the loan hasn't been forgiven. That was always a little bit of uncertainty. Okay, as of the 2032, as of the May notice, okay, we got to add them back. But when? Because most of these loans, most of your PPP loans, I know some of you may have already had them forgiven officially by the bank and officially by the SBA. But for the most part, most people are going to get that forgiveness and are going to get that forgiveness decision in 2021. So it was always kind of a timing question. Well, then IRS comes out in November and basically says, no, if you reasonably expect that your loan is going to be forgiven, you got to add that.
Bill, so this what this does now is it puts everybody into tax planning mode, right? I mean, we start dealing with all of our clients because now everybody is starting to say, okay, I need to reserve cash flow now to incorporate this into my tax planning, my estimates, whatever I need to do at the end of December. This totally changes the game now for everybody.
Yeah, I mean, it changed the game in November. And now this changes the game, right? Like I said, your whatever position you were in on Friday, again, assuming this is signed into law, your position has drastically changed as of Monday night. Okay, so now we get to the Appropriations Act, and it's in the the COVID-19 Emergency Relief Act within the Appropriations Act. I'm just going to call it the CAA for ease of our discussion here. But now we get to that, and now there is basically a one sentence. It's mentioned multiple times in the act, but it's one sentence. We can go to the next slide there, Frank. So this is right in the Appropriations Act, and I bulleted exactly what they said. Right? No. Okay. So this is Congress now. They basically restate, and they really did a nice job here in a very short, succinct sentence of basically saying we're not going to allow the IRS to have any wiggle room to kind of circle back on this and hurt taxpayers.
Yeah, man. Hey, Bill, I think that needs to be overstated, right? I mean, everyone's like, hey, it's not taxable. Good luck. But we don't trust the IRS coming back. Every time we read this, I mean, there's nothing the IRS can do at this point, in my opinion, to really make this decision change. I know we've we've laughed about the lack of clarity in some of this stuff, but I think this is pretty clear, correct?
Yeah, I mean, this is pretty clear. I mean, I'm sure somebody will find a way or a reason to make it unclear, right? But it's pretty clear, right? So they restate it's not included in gross income. Then they make these three positions in the next bullets here, which they didn't in the CARES Act, which they probably didn't think they needed to. Okay, so one. No deduction shall be denied by reason of exclusion of gross income. That kind of gets back to the IRS, May position that they wanted to deny the deduction. No tax attribute shall be reduced by reason of exclusion from gross income. And this all kind of relates back to the PPP loans, right? So tax attributes, NOLs, credits, right? And that was always a question that I had. Well, what's going to happen to my clients that are getting R&D credits that had PPP loans, and some of those people that were eligible for the credits were paid with PPP funds. I think this provision basically says, hey, we're not going to allow the IRS to reduce that attribute by reason of exclusion from gross income, or the expenses are deductible at this point.
Yeah, I think, Bill, it's a big point. I want people to realize a lot of our clients still do a lot of work in the R&D tax credit with you and receive a lot of benefit both federally and in the state of Connecticut. Obviously, there's a big incentive. I think people need to realize now that there was some uncertainty that we believe now is cleared, and we're going to probably take a position that we're going to calculate your R&D tax credit in a manner that is assuming that it doesn't get reduced by any of this. So. Yeah,
I mean, there's still of all the areas that are mentioned in these bullets, Frank, I'd say that there's potentially a little bit of uncertainty there, but I think that this is certainly a provision that I'm going to rely on as I'm going through my 2021, tax work related to the 2020 tax year. And this would be kind of like, this would arm me with what I need to say, hey, no, you shouldn't be reducing the attribute here.
Yep.
And then no basis increase shall be denied by reason of exclusion of gross income. So, and so that's obviously very important in terms of pass-through entities that have S corp shareholders and pass-through members. that are receiving tax exempt income, well, they get the step up in basis. And so that on distribution, that doesn't create like a secondary taxable event. So I'm really pretty impressed with the legislature and Congress for getting that piece into it as well. So considerations, but we kind of just talked through them all through in the last couple minutes. But I mean, like I said, assuming this passes on Friday, whatever your loan was, you had $1 million loan, you had to reserve 400,000 of that, right? You're giving 400,000 back to the government. And that was on Friday. You wake up on Monday, assuming this passes, right? You just picked up another 400 grand. So that's pretty important provision. Pretty important.
Super critical from a whole host of reasons. You got more money to dedicate to getting through what is going to be a tough first quarter on the COVID side, right?
Yep.
And you don't have to. You don't have any questions anymore as to how you're treating it in 20, how you're treating it in 2021, and I think in some regards allows businesses to plan accordingly and put more of the proceeds back to the employees, which is what it was meant to be. So.
Yeah, I mean, that basis step up is likely going to be a 2021 event because, like I said, for most businesses, the loan hasn't been forgiven yet. And I don't know, Frank, if you want to talk a couple minutes on just from a GAAP perspective.
Yeah.
There's probably people on this call that may even had their loan forgiven, and then there's probably most of them have they've submitted their application but do not have a forgiveness decision yet. At least.
Yeah, as many of you know, we did a webinar, and so I think there's some slides that are on our website that kind of outlines the two main concepts of how to treat this from a U.S. GAAP perspective for financial statements. But the majority of people, I believe, will treat this as a loan instrument, right? It will be treated as debt, and then ultimately won't get relieved from your balance sheet and pushed through, in essence, other income as until the loan is technically forgiven by both your financial institution and then approved by the SBA. And most of my clients haven't even gone through that process. And if they have, it's been a very, very small percentage of my client base has actually gone through the forgiven process. Most banks, quite honestly, were telling clients to hold off because they had a feeling additional information was going to come through. So most clients will probably see this on their balance sheet still. And as a result of that, you're going to have some disclosures that are going to be required in your financials. And then as a subsequent event, if you do have it forgiven subsequent to your 12/31/20 balance sheet, you'll probably have a sub event talking about that forgiveness and disclosing to the reader that it will be pushed through the other income line in your financial statement. If you have any questions on that, obviously reach out directly to me.
Yeah. And so from a tax perspective, right? So, and again, this is probably most likely going to be a 2021 event, but it could be for 2020 for some of you folks, right? You're going to have other income on your financial statement, and then we're going to have an M1 adjustment for tax, right? So that's
yep. Absolutely, Bill. Sorry. Yeah, you're definitely going to add that back, right? So from your perspective, that income will be a reconciling item.
Yeah, we'll have an M1 adjustment.
Income.
Yep. So, and we would have had that adjustment anyway because it was always excluded from income, but now we don't have to add back the deduction. So anyway, end of the day, you're in a great position. All you folks that receive PPP loans, and all you people that all the folks that may get PPP loans going forward, because as we're going to talk about the new PPP round 2. But all these provisions apply. In fact, they also apply for idle grants and idle loans. So that have been. We're not going to get into too much of that, but to the extent you have another SBA loan that's been forgiven, these same tax provisions apply. So
agreed. It's a good point.
Keep it in mind. And like I said, just reach out to us or whoever your provider is when you start looking at some of those those forgiveness events. Okay, let's move on. This is a really significant one. I don't know that I fully grasped the potential benefit here until I kind of dug back through the language and kind of got myself familiar with the original employee retention credit. It's always been a good program, but however, it was always one that, at least for our client base, for the most part, not everyone, but a lot of our clients are in the small to mid-sized business range. We're eligible for PPP loans, and under the original employee retention credit, which was part of the original CARES Act, if you received a PPP loan, regardless of whether it was forgiven, you weren't eligible for employee retention credits. And so, just didn't come up. I had a few conversations with some clients that didn't do PPP, and there's some fact patterns here that we're going to talk about right now in terms of eligibility. But just for a quick review, this was a program that allowed companies that had one of two criteria had to take place. You either had to have a reduction in gross receipts in 2020 quarter, any quarter in 2020 relative to your 2019 quarter of 50%, right? It's a pretty large threshold. Or you had to demonstrate that your business had a full or partial shutdown as a result of a government order. Okay, and so, it's a big reduction. I know a lot of companies, took a hit this year, but that's a pretty big reduction. And that full or partial shutdown, you had to show that direct link. And so anyway, talked about it with a few clients. Didn't have a lot of takers on it, but it was a good program. So what it allowed you to do is to take 50% of the first $10,000 of wages of any of your employees, and you got a credit of $5K, and that would go against your payroll taxes. Two things apply though. If you're a large employer, which they defined as any business that had over 100 employees, that's a little typo. That should be 2019 average. You could only include wages for folks that were not providing services. So you basically kind of had to go through you have 101 employees, 500 employees, 1,000 employees, whatever you had. You had to go through and you had to say, okay, well, we had a reduction. We met one of the first two criteria, either a government shutdown or a reduction in gross receipts. And we kept all these folks employed, and they really weren't working. And there's a whole IRS lists a whole bunch of characteristics and examples as how do you demonstrate that, right? They're on the payroll, but they weren't providing services. If you were a small employer, so companies under 100 employees, you still had to meet the full or partial shutdown or the 50% gross receipt test. But any wages you paid to any employee, whether they were providing services or not, were eligible for this credit. So pretty big boon for the small employers as long as you met the first criteria. But if you got a PPP, you weren't eligible for the credit. So, most small employers were taking the PPP. So anyway, so that's the old program. We fast forward to the Consolidated Appropriations Act and the COVID Emergency Relief Act within it. Okay, two things. That program expired on December 31st, 2020. The new act extends the program through June 30th of 2021. Okay, great. It also increases the rate, not 50% of the 10,000, but increases the rate at which you claim the credit to 70%. Then in addition, and these things all go together, it increases the creditable or eligible wages, not from $10,000 a year. So under the old program, it's 50% on $10,000 of total wages through the end of 2020. Okay, so that's a credit of $5,000 per employee. The new program, effective 1/1/21 and through June 30th of 2021, allows you to take 70%, but it's of $10K per quarter. So you just went from a maximum credit of $5,000 per employee to potentially $14,000 per employee if you look at Q1 and Q2.
Direct credit, right, Bill?
What's that?
This is a credit. Credit off payroll, right?
This is a refundable payroll tax credit.
Okay.
So you're going to go on to your 941 and you're going to take that credit against your payroll taxes and request refundability, reduce deposits. There's a whole bunch of ways you can monetize this thing.
Yep.
Okay. Then next bullet, right? But also what it did is it reduced the reduction in gross receipts from 50% to an 80 or 20, depending on the way you look at it. It's a 20% reduction in gross receipts, but 80% of your gross receipts from comparable quarters in 2019. There are some or a prior quarter, right? So if you weren't in operation in 2019, you can compare to like Q4 of 2020 that under the safe harbor provision. So now you're looking, so that should expand the potential for businesses to fit within this piece of the criteria. The full or partial shutdown, that's still in existence. So if you can prove that, then great. But if you can't prove that or you don't have that fact pattern because you were listed as an essential business, by your governor or the CDC or OSHA or Health and Human Services, and that list of essential businesses is quite lengthy. For example, I was pretty surprised when it came out that an accounting firm was listed as an essential business, but it is. So as well as many other businesses, right? So, but now that reduction is only it's a 20% or 80% threshold depending on the way you look at it. That's going to open the door for a lot of companies that that may have kind of weathered the storm, used the original PPP. But maybe take a little bit of a hit in Q1 if you're below that, that 80% threshold of receipts as compared to your Q1 receipts in 2019. Well, now you're in the credit criteria, and because the employer, like the large employer definition is raised to 500, you have 120 employees, let's say, and you had this reduction of gross receipts to 75% of what your gross receipts were in Q1. Well, now, because you're a small employer, you're taking a credit on basically anyone that's providing any services for you.
Hey, Bill.
Yeah.
Can I jump in here?
Yeah.
You've done a masterful job, as always, of getting all the facts out. But for those of us who aren't as smart as you are on the legal side, and then you're obviously a whiz on the tax side, if I had to summarize this to my client who's, a small to medium-sized business, if you're under 500 people, you now have an opportunity to go back and look at this, right? Because let's assume most of our clients that were over 100 weren't looking at it. If you're under 500 and you've had any decrease in your gross receipts that exceed 20%, when you start comparing quarter to quarter, you now have the ability to get up to a $14,000 payroll tax credit. That's what we're saying, right?
Per employee. Yep. Per employee.
Right.
Yeah.
Per employee. Right.
The things that really, there's basically 3 points here, Frank, that really open the door for this for businesses that are, let's call it small business, right? But it applies for larger businesses as well. But for companies that are under 500, one, if you had a PPP loan, or you're going to get a round 2 PPP loan, you're now eligible. You're now eligible.
Doesn't matter.
What's that?
That doesn't matter anything.
It doesn't matter. Now, one caveat to that is if you get the round 2 PPP loan and you're using funds to pay payroll, you can't also take a credit on that same payroll dollar. So, you're not going to get that double benefit. But let's say you get a PPP round 2 loan and on January 15th, and I don't know how quickly they're going to roll this thing out. But let's say you get it on January 15th. And you pay it over 8 weeks, right? So that gets you to February, approximately March 10th or somewhere in that range, right? Well, okay, so maybe you can't use those funds for purposes of determining your eligibility for for purposes of determining your credit amount for your Q1 credit. But you can use everything that was paid until January 15th, disbursement date, and then everything that was paid after March 15th up to March 31st, and then you can use anything that was paid in Q2, assuming you're still eligible. You just can't use the same dollars. But the fact that you got a PPP loan doesn't exclude you, which previously it did. So that's one, right? And then second is, under the old program, you had this, if you had under 100 employees, then you could take credit on any employee that was, whether providing services, not providing services, you could take credit on them. Now the credit was capped at $5,000, but you could take credit on them. If you were over the 100, you kind of became what they deemed to be a large employer, and now you could only take credit on people that you were paying that weren't providing services, and so that becomes a little bit trickier to try and document, a lot of folks that may have people that are not providing services may not be employing those people. So, so you've got that criteria, and then you've got the increase in the rate. So this is like a triple whammy in terms of more companies in the 80% threshold versus 50, right? So really 4 prongs there that are really opening the door. And I've already sent an internal email to the folks here, Frank. I'm sure you got it. Listen, we need if we have clients that we know are be taken, or if you look at 2020 and they had a reduction of 20%, let's at least get it. Let's start monitoring that and get that on the radar screen, because this could be a huge boon for companies, even if they're going to get the round 2 PPP. So anyway, there's a provision in there that goes retro back to the 2020 that allows you to claim that the employee retention tax credit with non-PPP funded wages. So that whole principle about being eligible for that applies going back to 2020. And I'm still trying to figure out some of the logistics on this, but I think you could do it for Q4. So, but you're under the old criteria. So I think you're under the 50% and the $5,000, the 50% on 10,000 of wages. But but you may have something here going for Q4 as well, even if you got a PPP loan. I promise that we'll, in our next webinar, I'm gonna try and get that ironed out. But,
yeah, I think, listen, I think we got the facts out here, Bill, is that I think most companies need to just take a fresh look at the ERTC and in a way that just make sure that they're not leaving some money on the table here. And it opens it up a lot broader to companies that have PPP loans. And I think they need to take a fresh look at this as we turn ourselves into the new year.
Yep. All right. I think we can move on from this one. Yep. Tax provisions. Most of these are kind of on the business side, the educator expense. I guess could be both, but this was interesting. Little carve out provision on meals and entertainment, and if you understand what's happened to our country in the last 10 months. So previously for meals and entertainment, as most folks probably know, that I forget what year, but that became a 50. It was a business lunch, business meal, business entertainment expense that got reduced to 50%. From 100% deduction for 2021 and 2022. Congress is basically telling you go out and eat, go to restaurants and bring your clients there. Assuming we're social distancing and
exactly
provisions. But
I think what they're saying is go back out and spend as much money as humanly possible and get a deduction for it in 21 and 22 here.
Yeah, I mean that's basically what they're saying is that, and so and that's all all throughout all these acts, right? You see where the legislative intent is. So anyway, that's there. The family paid leave credit got extended to March 31st. And then the educator expense deduction, there's a deduction that's effective for any PPE purchased as of March 12th.
Yeah, we're gonna move forward. Yep. We got a lot of stuff here, but we'll probably jump into this a little bit more in detail. But if you have questions, reach out to your tax provider. Hopefully it's us. So, okay, PPP round two.
PPP round two. Okay, so we've got the $330 billion allocated to this. I think round one, the numbers were in the 506, maybe 565 was ultimately paid out for PPP round one funds. So we've got 60% of that roughly into this round two. This is going to be more targeted. It's targeted towards, as I put up there on the slide here, right? So there's distressed businesses, live venues, movie theaters, cultural institutions, low income and minority communities. Okay, so that's who they're trying to allocate these funds. If you were with us in some of our earlier webinars, it was always a surprise that when this program came out that they didn't do that originally, right? Why not allocate specific funds to the businesses you knew were going to be really devastated by COVID? And maybe we didn't know at the time, and maybe that's why it wasn't. But now, obviously there's more data on this, so they're really targeting this. Okay, so we go to who's eligible for round two. Had to be in operation as of February 15th, 2020. That's the way I read it. Still trying to get some,
Yeah, I agree, Bill. I think you and I went back and forth on this, but it definitely does state if you're not in operation before that you're not eligible for this round. So. Yeah,
that's what we're going with for today. 300 and fewer employees. So if you recall, the old standard was 500. Now we're down to 300. Now I just want to state this, and I reading through the act, there is language relating to 500 employees. And I did read a review. I think it was by the AICPA. They may have superseded that already, but they did make mention of new borrowers having a 500 employee limit. I'm still trying to work out the kinks on how does that actually interplay with the language? I mean, with the act. I mean, could you have 450 employees, but you didn't go round one, and now you're eligible? Most of the write-ups that Frank and I went through, we didn't see that, and the language in the act is a little bit tricky to kind of navigate because this 5,593 pages is consistently referencing you back to the CARES Act. and amending and striking out words. So you really have to have both acts open, and both, you're looking at
Yeah, to be continued,
8,000 to
Bill,
9,000 pages worth of reading.
I think we're gonna go with the 300 number,
Yeah.
because I think you and I both agree that that number seems more consistent with what we've been reading.
Yeah,
So-
yeah. I just want to make folks aware that that's where we think it's at. But if
Could
you're
change.
over that if you're between 3 and 5, get back to us and we'll make sure we get through that. That language. Okay. Use the full amount. So you can't have a kind of an outstanding PPP loan that you haven't expended yet. Okay, so now we get into the you have to have a 25% decline in revenue in any quarter as compared to the same quarter in 2019. I have a note here, clarification on cash versus accrual. I didn't see anything. I do know that the Act references accrual-based accounting and a bunch of other provisions. But you're basically looking at revenue, right? You're looking at revenue. You're comparing against a comparable quarter in 2019. You're saying, okay, did I have a 25% reduction in revenue, decline in revenue? If you did, you're now eligible to get into this round 2 of PPP funding, and that's any
Bill,
quarter.
do we think it's any quarter at this point, right?
I think it's any quarter.
Right, so you can do a Q1 comparison, a Q2 comparison, a Q3 comparison. If you hit that 25% threshold, I believe you are now eligible to participate in this round 2.
I believe that's the way I read it. Yep.
Okay.
There's some special rules for companies that were not in business in 2019, but were in business prior to 2/15/20, as we mentioned. New PPP borrowers, we put in there the 501c6. That's now an included eligible PPP eligible applicant. Those are typically business leagues, chambers of commerce. I don't know if you had any more comment on that, Frank. I know.
Yeah, I think it became apparent, professional organizations like, we have here in Connecticut. I think ultimately there were some limits on what not-for-profits were able to participate in the PPP, and that extended or expanded, with this round 2. And I think it's definitely, if you were not considered eligible in the past, it's very, very important that you reach out to your providers and double check now the new language, because I think it's going to extend into a new round of not-for-profits, which is great because those are struggling just as much as anybody else right now. So.
And then similar with the original CARES Act, you've got the accommodation and food services businesses. That's your NAICS code 72. That's all measured on a per location basis. So, a lot of these food service companies may have, more than 300 employees, but less than 300 at a location. So,
hey, Bill, and those service operations also get an additional kicker, right?
Yeah, we got that coming. Yep.
Okay,
yep.
Great.
Yep. Now this last bullet before you move on that, Frank, this is this could be pretty important, especially for partnerships. As you recall, and there was a lot of stuff that came out with the interim rules and the FAQs and everything else, right? But there was a lot of uncertainty, especially in April and May, as to what's included as an eligible cost for purposes of the application. Can I include partner compensation? Can I include independent contractors, right? Can I include employer withholding taxes? We had all this big debate, right? And a lot of that stuff went away, but partnership comp did not. And but by that time, a lot of partnerships may have already submitted their application. They excluded their partner comp, and so they got a loan of X dollars, right? Well, they really could have gotten X plus 1. So this, or they may have read, what was it, question 31 on the business necessity and said, I'm giving it back, right?
Yep.
And so this allows them, whether you didn't get the full amount that you were eligible for, or you gave it back, it allows you kind of like a second opportunity. Now, I put in the maximum here at 10 million because that was the old max. I think that's the max. I'm going to confirm that, and not the new max, which is 2 million. Which we're going to go through in a second here. But just be aware, if you got a PPP, round 1 loan, and you're like, we didn't get as much as we were eligible for, you have an opportunity now to basically go back and get more under the original program.
Hey, Bill, real quick, it's a great question. If you're not a targeted business, you're still eligible. You just have to meet the criteria, right? I mean, I think what we're trying to say in that first bullet is a lot of what they did here was to try to help those targeted type businesses, right? But if you're a manufacturing company and you have a 25% decline and you meet the 300 threshold and everything else, you can apply, correct, Bill?
Absolutely, yeah. I probably didn't do a good job of that on the slide, but in the parentheses, any type, that's kind of that's what I meant. So when you look at distressed businesses, that's that 25% revenue test. That's anybody, manufacturer, accounting firms, whatever your business line is. You're as long as you meet that 25% test, then you're considered a distressed business and you're eligible. Then they also set money aside to the live venues, movie theaters, cultural institutions, and all these other things that I note here. There's some more where they specially allocated a piece of that $330 billion and said, we're not allowing manufacturers and accounting firms and law firms to touch this money. That's going to be separately allocated to those live venues and so forth. Okay. All right, let's talk about eligible costs. The first four, I'm sure you guys are all very familiar with. Those carry over to the new program. But here we go. Now they've added a whole bunch of new costs, and again, legislative intent. You understand what they're trying to accomplish here. One, they're trying to. I don't have it in the slide here, but we're still dealing with the 60% payroll threshold. So just keep that in mind. That you still have to spend 60% on payroll through their weird calculation on the application, which I don't know if the new applications will change the way they do that, but it was always take your payroll cost and divide by 60, and that becomes like a cap on loan forgiveness. But anyway, so you've got those four categories, the top four there that we've discussed. Now you've got new ones, right? So you've got the covered worker protection expenses. This is interesting. So it's defined as an operating or capital expense to facilitate adaptation of the business activities of an entity to comply with requirements established or guidance issued by the Health and Human Services, CDC, OSHA, or a state government. Operating or capital expense. They go into some examples in the act, and some of them are like creating additional drive-through windows if you're a restaurant. They are related to creating like social distancing, maybe special cubicles, something along those lines, right? That may be capital in nature. That was, capital in nature was never a piece of any of these, COVID programs or the PPP program. But you got something here that you may have some capital expenditures that may be eligible for use based out of PPP funds. Keeping in mind, you still got to have the 60%. Covered supplier expenses. So those are expenses made to a supplier of goods for the supply of goods that are essential to the operations and for which a contract was in place prior to your covered period. Okay, so if you got the loan on January 17th, 2021, you can't go out and start buying supplier goods and have a new contract, right? That contract had to be in place prior to your covered period. Now, I think they're going to speed up the application process. So, that might be something you want to get in place now if you're thinking about applying for round two. Covered operations. This one's pretty well defined. I'm just gonna read it for you guys so you can see it, and we'll put it in the slides. Payment for any business software or cloud computing service that facilitates business operations, product or service delivery, the processing, payment, or tracking of payroll expenses, human resources, sales or billing functions, or accounting or tracking of supplies, inventory, records, or expenses. So I got this question quite frequently in the last 6 months. Hey, we spent X dollars on software, and so within utilities it was telephone, but also the transmission of internet, and so a lot of questions about like, what do I do about my software, right? What do I do about my cloud computing expenses? And so in some instances it was a little bit uncertain.
Yeah, I think this clarifies a lot of that though, Bill, right? I think most of those are now going to get included. And And
And
they're
this is
only
round two
includable
spend.
though in round two, Bill, or
Round two, yep.
yeah, it
Yeah.
doesn't clarify your PPP loan for original, right?
Yeah, I don't. The way I read it is you can't go back to your PPP. And I have a client that could take advantage of this because they, just based on the loan mechanics, they got more than they can spend, and so I have to look back at it. I don't think they're going to be able to, but they would benefit from that provision because they have a lot of cloud computing expense. So anyway, round two, you can get to take it, and then property damage. So this is related. So this is basically property damage or vandalism, or looting during, due to a public disturbance that occurred in 2020. And, unfortunately, there was a fair amount of that went around, and all across the country. And so to the extent you had damage that was not covered by insurance, as a result of that. And I don't know, might be a little bit difficult to define. I'm not sure. I haven't seen like how you exactly define that. I mean, you kind of know it when you see it, but I don't know if there's a specific definition on it. But if you had that, there's another covered cost. So anyway,
Hey, Bill,
you got more costs here.
Hey, Bill, really quickly, I mean, there's been a bunch of questions because we do a lot of, high growth companies and entrepreneurial companies, and they're asking about pre-revenue companies. If you're pre-revenue, I don't think at this point you can apply for the second loan because you're not going to be able to prove revenue decline, right?
Correct.
I mean, it's a very interesting point that we hadn't really had time to think through, but if you don't have revenue and you obviously can't show a decline in revenue, I don't think you're going to qualify for round two at this point. So.
Yeah, no, it's a good point. I don't know if the act even it addresses being able to use the prior quarter, right? Those special rules if you weren't in business for the full period, but it doesn't. I don't know that it addresses zero.
No, I don't think so. So let's keep going, Bill. We've got a couple more slides. I want to make sure we get through them all.
Yep. Sounds good. Okay, so clarification here. This was a issue in round one. 8 weeks, 24 weeks, or something in between, right? The legislation said 8 or 24. This is going back to the original. The instruction said you could use anything in between, but then the banks weren't open until 24 weeks is kind of up for most folks. Under the round two, they clearly state that you can use any period after 8 weeks and before 24 weeks as your covered period. Loan calc, 2.5 times monthly payroll, very similar for most folks. Calendar year, I think that's a typo we'll fix on the other slides. I think you're looking at 2019 for that.
Yeah, I think it's 2019, Bill.
Yeah. If you're in that food service or accommodations business, you get 3.5 times monthly payroll, and your loan is capped at 2 million, versus the old 10 million. Simplified application. So this was something that that Congress really wanted to make sure that again, you kind of saw that coming through the SBA, but they're going to simplify the loan application, the forgiveness procedures. I mean, they're laid out right here. If you have a loan of $150,000 less, you're basically given a one-page document, documenting the loan, the employees, and the amount spent on payroll. And if it's a loan between 150K and 2 million, then a lot of the stuff that gave a lot of my clients grief during the last last couple months, let's say, of just getting all this documentation and getting it into the bank portal. You're not going to have to provide that. You're going to have to retain it, but you don't have to provide it.
Hey, Bill, just something to make people aware. I mean, the documentation may be getting simple, but it's been clearly defined that you're going to represent that everything you're stating is still true and accurate. So, most, if not all of our clients are always truthful and accurate, but if you're still unsure as to whether certain things are qualifying or if your calculations are right, you need to make sure you're doing your homework because you're going to be basically signing something that's representing the fact that you're accurate and you're truthful in your application. So.
Yeah, absolutely. I mean, you probably have to go through the same process anyway. You just won't have to put it on the bank portal. It would be wise to go through the same process. Make sure that you can verify various payments. Hey, could you go back for 1 second there, Frank? This last bullet is important, right? Repeal of the ad. So for some folks that got the EIDL grant and the PPP, you might have gotten a grant for up to $10,000 that reduced your PPP forgiveness. They repealed that provision. Again, another issue I'm just trying to get clarity on. I think that goes back to the original CARES Act. Now, what happens if you already submitted your loan application? I don't know, but but if you got an EIDL grant and you got a PPP loan of $200,000 and you otherwise met all your spending criteria and you didn't have any reductions, you would have gotten forgiveness of $200. That number came down to $190 if you submitted your application already.
Yep.
I'm trying to get clarity on that, but I think that it's also applicable to round one where you get that $10,000 back. You get the grant and you get the PPP forgiveness. So,
hey, Bill, really quickly, the loan calculation, it's average monthly payroll, right? I mean, it's not.
Yeah.
Those are, for those of you that are seeing it, I mean, Bill and I literally last night and this morning were pounding these slides out, so we may have lost a couple of words but this is not different than anything else, right? You got to go and calculate your average monthly payroll for either the prior 12 months or for the calendar year 2019, and then you take 2.5 times that.
Yep. So. Yeah. No, I mean, the calculation isn't very different from what you've already gone through. Yep. Okay. Individual stimulus. This basically they're doing kind of like they did in the last stimulus package. It's really an advance on a tax credit, and we talked through that in a prior webinar. But that's the mechanism, right? So you get kind of an advance on a tax credit that you'll get on your return. But those are the numbers, right? $600 for individuals. You see the phase out. $1,200 for married couples, $600 for qualifying children. I think, Frank, you had a comment on adult children over 17 or something. They're not qualified children.
I mean, I think there's some people have adult dependents, like kids going to college, stuff like that. You're not going to see them be eligible if they're your dependents on your tax returns. So,
yeah. And the fourth bullet down there, that's the phase out rate. So, it doesn't take much, it's basically $12,000 over the numbers here when you're fully phased out of the check.
Yeah, and they're using 19 as your measurement year for this because obviously that's the last thing they'll have, even as they kind of roll these things out over the next week or two. The people, there's a lot of different things here that also, charitable contributions and flexible spending arrangements and other things that we're not going to get too far into here. That I think as individuals, as you start planning your tax planning individual wise in 2020, you need to kind of work with your advisor on. So.
Yeah, I'm not going to get into the specifics on these, but just there are just within the last piece of the act, which is just give me a second here. It's not even the last piece, but it's toward the end. The Taxpayer Certainty and Disaster Tax Relief Act of 2020, which is all part of the appropriations. There's approximately 70 tax extenders and tax provisions, exclusive of what we talked about, which was the most important one, which was on the PPP, and exclusive of some of the other items. So you've got a lot of tax things to consider here. We'll probably do a tax only, and I'll get some of my other tax partners to go through some of these things in a little more detail, but there's a lot that's out there.
Yeah, I mean, we've also included here the unemployment assistance changes and impacts. These are things that, like we said, we help with, certain legal firms that we work with, but we wanted to make sure that you understand that, the unemployment assistance, or PUA, as people kind of refer to as, was extended. We got the pandemic emergency unemployment comp was extended. Supplemental unemployment insurance benefits were extended. So and then there's a Return to Work Act. So states now need to allow employers to have one process to report employees that are been offered jobs or offered to come back to work and they refuse because they are either unwilling to, for a variety of reasons, whether they want to take advantage of the unemployment or whether they want to be overly, they're a little skeptical as to whether they want to go back into a workforce. We've had a lot of questions early on about employers having employees that are unwilling to accept jobs or unwilling to come back to work and what it means. So there's obviously some recognition of that in the new act as well. So.
Yeah, and I just want to get this last piece on debt relief. So folks that may have had other Section 7A loans, the PPP is now kind of under that umbrella, but other small business loans, you've been provided debt relief in the form of the SBA will pay your principal and interest. That got extended for, I believe it was 6 months at some point in 2020, and now that they've extended that for 3 months. Starting on February 1st in 2021, and then an additional 5-month period if you meet any of these NAICS codes. And there, I didn't put what they all are, but like 72, we know it is the food and accommodations industry. And if you just do a Google search of those code numbers, NAICS, and put in the number, and you'll see whether you fit into there. But I have to have the existing loan, obviously. But that's also a pretty significant benefit for companies that have those existing loans.
Yeah, I know a lot of the smaller companies, Bill, they have certain even equipment financing loans through the SBA and stuff, and they get those now paid or relieved. Really important for some of these small business punching through the impact. Listen, that was perfect. We're at 1 o'clock exactly. We didn't even practice. So I think, there's a lot there. I know we've had a lot of questions coming in. We don't know exactly the specifics as to when this next round of PPP loans is going to start coming out. I know I had one bank reach out to me and said once their portal is set up again to start accepting the second round of loans, they will let us know. So I think you're going to reach out to your financial institutions as you always would and just say, hey, I think I qualify. When can I get my application in? I think the banks are more in line to react to that. They're going to have their portals already set up from the last time, so they probably need to make some adjustments to the certain criteria, and they're going to I would assume they're going to let people know. So again, some questions are coming in as regarding to the calculation. We don't believe the calculation of what you're eligible for has changed. You're still going to have that 100K limit on salaries. You're still going to take 2.5 months average payroll. So none of those things we don't believe has changed. If we haven't noted something is changing, to Bill's point, you're referring right back into the original legislation. So you're doing everything similar to that, right, Bill? Is that a safe assumption at this point?
Yeah. Yep. Right back into the original CARES Act, and then all those interim rules that came out through the SBA and the FAQs, other than these new stuff, the new covered expenses and so forth, right, and the 3.5 times for the food industry. I mean, other than that, it's pretty similar to what it was.
Yeah, and then Bill, do we know? It's a good question. I can't remember if we talked about it. So when you go through your forgiveness process, the simplified rules for the 150 and then between 150 and 2 million, are those applying to those forgiveness rules now apply to the first round of PPP or just the second round? Do we know that yet?
I don't. That's kind of a piece that I was really trying to locate in this act, because most of the write-ups you see don't really, some of them do in certain provisions, but I don't think so, Frank. I think that that's a round 2, but I don't want to. I say that with about 50% certainty.
Yeah, I mean, I know there's some questions on seasonal employees exemption, the 300 count. I mean, yeah. There's definitely some information in there regarding seasonal employees and what it does to impact the PPP2 round 2. We didn't get into it. There's so much there. So I think you're going to need to stay tuned if you're interested in very specific points that are going to impact your ability to take advantage of some of this stuff. I think the best thing to do is to reach out to your providers and your experts and ask your questions and understand that there's 5,600 pages or whatever it was, and there's a lot to digest, and you're going to need to give people a little bit of time to get into the details. The details matter on some of this stuff, and I think Bill and I were talking this morning early about, the details matter, and we're not going to be able to answer as many of your questions as we probably will as we get a little bit more in depth on some of these issues. And we'll continue to pump out information as quickly as possible. But I think hopefully what we've been able to do, Bill, is to give people some knowledge as they go into the holidays that they can start pondering over dinner. No one's going to see anybody anyway, Bill, so they're just going to be sitting there drinking a glass of wine and thinking about the new COVID Relief Act and how it impacts their business and individuals. So they'll write down all their questions, and hopefully we'll start being able to answer those after the holidays.
Yeah, I agree. I mean, as you and I talked about this morning, Frank, I mean, the ands, the ors, the placement of commas, semicolons, what have you. I mean, it's important, and I don't want to kind of blow right over the details, but those things really matter, and I think we'll have like a really better handle next time than we do this time. We really wanted to get out there and set the table, really. I'm talking about dinner here, but setting the table and just saying, hey, these are the things that are out there. At least, hopefully, you got a sense of where these things are going. Hopefully, we gave you some certainty on the tax piece. But you know what to talk, what to think about, and now it's just kind of ironing out a few little details to determine eligibility, so forth. So
yeah. So listen, we've given you our contact information. We always do. Reach out. We also have our web resource page for COVID-19 on our website. And we do appreciate, we've had a lot of good feedback from people either in the comment section here and also emailing us directly. We appreciate the fact that people find these very useful. Quite honestly, we find them useful because it helps us prepare for our conversations with our clients. We're happy to answer any questions that you may have. We'll get a recording lined up. We'll also, get a get the slides out to people, and hopefully everyone's able to have a great holiday season. I know Bill and I will be working diligently between Christmas and New Year's to prepare for our next webinar because we enjoy these so much. So. Bill, any closing words?
No, I think you covered it. Just want to thank the audience for attending, and hopefully we'll be talking soon.
All right, great. Happy holidays, everyone. Talk to you soon. Bye now.